Hello everyone. Today we will discuss a new topic under banking and insurance law. Today's topic is nature of securities and the risk involved in these securities under banking industry. The list of topics to be covered here is concept of securities, types of securities. There are three types: equity securities, debt securities, and derivatives. Then we will discuss all the risk involved with these three securities. The concept of securities. A security is a financial instrument, typically any financial asset that can be traded. The nature of what can or can't be called a security generally depends on the jurisdiction in which the assets are being traded. Types of securities. The term securities broadly cover all traded financial assets and breaks such assets down into three primary categories. First is equity securities, which includes stocks; debt securities, which includes bonds and banknotes; derivatives, which includes options and futures. Equity security. Equity almost always refers to stocks and a share of ownership in a company which is possessed by the shareholder. Equity securities usually generate regular earnings for shareholders in the form of dividends. An equity security does, however, rise and fall in the value in accord with the financial markets and the company's fortune. Debt securities. Debt securities differ from equity securities in an important way. They involve borrowed money and the selling of a security. They are issued by an individual, company, or government and sold to another party for a certain amount with the promise of repayment plus interest. They include a fixed amount that must be repaid, a specified rate of interest, and a maturity date, the date when the total amount of security must be paid by. Bonds, bank notes, or promissory notes and treasury notes are all examples of debt securities. Derivatives. Derivatives are a slightly different type of security because their value is based on the underlying assets that is then purchased and repaid, with the price, interest, and maturity date all specified at the time of the initial transaction. Risk involved in securities. There are two types of risk factors involved in securities: general risk factors and specific risk. General risk factors. There are a number of defined risks associated with investment activity of which investors should be aware. Among these are the following: market risk, the risk that changes in market prices have an adverse effect on the asset values; interest rate risk, the risk that changes in interest rates have an adverse effect on the asset value; currency risk, the risk that exchange rate movements can affect values where the asset price is denominated in a foreign currency; liquidity risk, the risk that an investment may be difficult to sell in adverse market conditions; economic risk, the risk that adverse economic developments may affect assets value; legal risk, the risk that changes to the law could affect the value or marketability of a particular investment; country risk, the risk that the value of an asset located in a particular country may be adversely affected by political or economic developments in that country; inflation risk, the risk that price inflation could affect the real value of an investment; counterparty risk, the risk that a counterparty may not meet its contractual obligations in full. Now let's discuss certain specific risk factors. In addition to the general risk sets out previously, there are also risks which pertain specifically to separate asset classes. These are described below. Equity shares. Investing directly in shares may involve the following risk. Company risk. Company shareholders are directly exposed to all matters affecting the business and operations of that company and in the extreme could lose all of their investment. Price risk. The price of a company's share can be affected by market factors which are independent of the underlying performance of the company. Dividend risk. Future dividend payment can be affected by a range of influences, and the level of such payments cannot be relied upon by investors. Bonds. Purchasers of bonds are in effect lending money to the issuer, whether that be a government or a company. As a result, the risk associated with bonds can be very different from shares. Among the specific risks are the following. Default risk. The risk that the bond issuer may not be in a position to pay interest or repay capital or both. Interest rate risk. Most bonds pay a fixed rate of interest, and as a result, their market values are negatively by rises in market interest rates. Funds. Funds are collective investments, and the category can include quite a wide range of structures. Most funds available to retail investors are open-ended structures offering a high degree of liquidity. However, the category also includes closed-end funds which may be listed offering good liquidity or may be unlisted with very limited liquidity. Among the specific risks pertaining to funds are the following. Redemption risk. While open-ended funds offer regular liquidity, this feature can often be withdrawn temporarily in adverse market conditions. Regulatory risk. Funds located outside of the EU may be subject to lower investor projections or varying regulatory issue compared to the funds regulated inside the EU. Gearing risk. Some funds are authorized to use gearing or to invest in derivatives which may substantially increase the underlying risk. Diversification risk. Funds investing in a very narrow range of assets may carry a much lower degree of diversification than might be expected by the investor. Evaluation risk. Funds investing in illiquid assets may be difficult to value, particularly in adverse market conditions. Management risk. The performance of a fund will depend to a great degree on the competence of its management. Poor decision making by the management or the loss of particular individuals may have a significant influence on the performance of that fund. Unlisted securities, shares and bonds not listed on regulated markets carry particular risk as a result of being unlisted. Among these risks are liquidity risk. Unlisted investments may be highly illiquid, which may affect not just their ability of trade but also their pricing and transparency. Information risk. Because unlisted structures have lower disclosure requirements, the information available around the company's operations and performance may be very limited. Small cap risk. Unlisted entities are commonly small in comparison with their listed counterparts, which increases the risk of default, insolvency, etc. Inflation risk. Inflation risk applies to all bonds. This is the risk of inflation eating away at your returns. For example, if the bond yield is 8% and the inflation is 8.5%, you will actually end up losing money in the bond. This effect is strongest in the longest tenure bonds like perpetual bonds, which have indefinite tenure. Why? In shorter dated bonds, your money comes back faster and you can always reinvest it in bonds with higher yields and or in assets like equity and gold. These assets, although volatile, tend to give better returns than bonds when inflation shoots up. Interest rate risk. Higher interest rates often follow a rise in inflation. When interest rates rise, bond prices fall, and vice versa. The effect is particularly strong for long dated bonds and hence also for perpetual bonds. A drop in the bond's price does not hurt if you intend it to hold it to maturity. However, if you want to sell it before maturity, you will get a lower price for your bond in the market. This is due to the effect on bond prices at an interest rate hike.